Hello and welcome to this quick presentation of the impact of volatility on the market. So we have daily volatility represented by VIX.X. There's a 9-day, there is 3 months, 6 months, 9 months, and they make a lot of complex shapes which we can also use to generate profits by playing one volatility against the other and generating the bias. And we can also sense the direction of the market by, when I say market, think about business cycles by looking at the contango, the differential between the various term volatility structures. Now what we are here is to talk about when your volatility is at the lower ranges. That means your option prices, which drive the stock prices indirectly, are priced mostly correctly, which also means you can buy insurance and hedges against your investment protection at a much higher level. Buying insurance here, expecting market to go down even deeper. When market is in a panic situation, buying the protection at this level is expensive. Buying the protection here is cheaper, because if you look on the lower band structure, we are playing the low volatility ranges. That means there's a calm in the market. Market is generally bullish, is drifting higher, and then panic hits. Boom. Right? When it goes 300 points, the news starts playing the game. Everybody can see this, right? This is something, there's no edge because all people can see it. So now the story right now is that the insurance is pretty cheap at this level and protections can take place. The reason where we are interested in picking the panic bottoms, depending on the structure you are profiting from. When the panic hits and the volatility really takes off, that means everything becomes expensive. So everything is expensive, I can sell the expenses driven structures like sell the puts even much lower. So I can be offsetting my investments much lower, right? But the point right now is not how to structure the deals. The point is protection. And understanding this simple structure will help you understand the points, inflection points in the market. While market is typically extremely long term, they drift. It drifts and drifts and drifts. If you look at the Dow, last 100 years, 120 years, right, it drifts up. So just because it is low doesn't mean it's going to crash. That means there's a calm in the market. When everything is calm, everything is cheaper. That means you can buy protections. So then we know the things, what hits the market and what happens. That's a different story. So that's one thing, right? And then what we have is the peaks. So we are also interested in those peaks where the panics don't last forever. They subside one way or the other, right? So let's check that quickly. So when you hit these extremes, okay, in the top extremes, you're typically finding the bottoms. and the bottoms can go 300, 400 points. But when you're buying the calls here, they're overpriced. So market is going up, you're hoping you're making money, but you will not. Your break-even point goes much higher because of the implied volatility, as you guys know that. So this is where you can, to overcome any volatility conditions, you can do spreads, or you can sell the puts lower based on what you're doing. 50% lower, 25% lower than the current price. So you're collecting the premium plus you're offsetting your entry by 25%, right? But you should know if the bottom is coming in, are we in the right location? Now this doesn't pinpoint to the day, it just gives you the location. So let's look at those areas, right? So let's look at this guy right here. We got a bottom. Now this is daily chart on both sides. Bottom, roughly bottom, right there. How about these guys? Bottoms. These guys, and this guy, a little bit bottom, not much. This guy, big bottom. This guy, big bottom, right? So this guy, bottom. So these are the 3-4 months up, 4-5 months down, 3-4 months up. So since October, and this is April, it's almost like 5 months, 6 months, right? 6 months of uptrend, which was picked up by this guy. We had a panic a little bit here, a correction in March, and then it goes again up. So you understand that even the basic unprofessionals or professionals also, unprofessionals can start here. When I say unprofessionals, that means you're not managing professional money. That means you're in retail market space, you may have millions. Now this is not the only volatility models they get into. Contangos is what they use to get the bias. Which side is market is going to go based on how the things are priced and based on multi-term structures of volatility. That's beyond discussion of what we are doing here. So we are noting the basic fundamental stuff. So what's going on here? You simply put on some bands. Every software has this. You can put on the Keltner's channel 60 and 3 as I show here. You can put on also, what else I have got, Bollinger Bands 45-2. You can also go to 60 and 2. This is giving you the tail risk on volatility, the edges. Again, daily is the place to go. And now what I'm showing you is on VIX. You can go 9-day, 3 months, 6 months, and then you can see, or you can create a composite of it. Sum of all the 5, at least 4 volatilities. There are 4 volatilities, divide by 4. Get the average out. And then you put these bands on it, right? Because what can happen is this. See this? The calm is going on. Calm is going on. No one wants protection. And boom. Right? So always be cautious. Now calm can last forever. Right? So don't try to pick. This is the top. This is for picking the bottoms, not picking the tops. Once you are extending yourself, right? Sometimes it happens, sometimes it doesn't happen, because you can keep drifting. As I said, you can keep on drifting. Here we're expecting, oh my god, it's going low and low and low. Why it's not dropping? Well, it's not really a big drop here. It's just a small 100-point move. It can happen in one day. Panic hit. So you want to pick the bottoms for selling the puts or positioning in stocks, or you can. Now this is on daily. So once you see this panic is hitting, businessmen stop investing, because when the fear is set in, you want to be taking the opposite side of fear. What happens is fear gets more fearful. This is where the problems are, of not knowing structures of the business and finance. So this is what it is right now. Excuse me. It's a good opportunity of putting on some hedged positions against your long business agendas. If you have investments, you can pull your protection. The banks have pulled their protection from here all the way here, right? So that they're selling this protection from here. They're rising up, rising up, rising up. What's going on here? If it goes down, the protection will kick in, and the premium paid for it is gonna be offering much better return. The reason is implied volatility goes up. Not only your insurance is making money, but insurance itself gets into higher premium because of the implied volatility. Just wanted to bring this to your table. This can be managed by anybody. Everything I showed you right there, I gave you the idea also what to do. Doesn't need any professional. And this is a symbol depending on the platform. It's all on the internet for free as well, and this is the SPX.X, the entire market space. So keep these cycles in play and keep an eye on this and see how over the time periods I can make some don't know what I clicked on, but weekly. You look at the panics in the market 2020. Let's move this to weekly also, because you may not be interested. Panic, right? There we go. Extreme panic. It went to 80. We were in this profit going down. We were also in profit going up because we know what we were doing, right? But now you can do the same. So you have to patiently wait for playing 3-4 panics a year if that's what you want. For business people, it is good to understand these points, and this is how technically you can understand a little bit more than if you don't know. At least you got a better idea. So here, when you go to weekly charts, your ranges of inflection points will change as well, right? So here, what happens in the last 6 months, once a year, what's going on? Well, this is end of the panic in October, and we called it by different means, but here again, right? So where are we now? In a calm phase. We are in a calm phase. Calm phase can get some into panic state. See this bottom, can get into panic state. Can get into panic state. But it can stay in the calm much longer, and this is where it is very difficult to pick the tops, because it can keep on drifting in a calm phase, and something has to hit it to create the panic. So it's easy to pick the bottoms, and you know it beforehand, and you can make the right investments. If you look at this 2019, look at this guy on the top on a weekly chart, right? So how high it will go depends on the panic views, because algos feed on each other. Look at this guy. Let's see which one is this one. A small panic move, nothing much. So we got, as I can show you, all these are picked just for you right here. And this is very 101 in the financial world. See here, panic, picked the bottom. Here also, pick the bottom, right? So once this is picked, then you know next 1 year, 6 months, you're in a bullish zone. If people will invest, get excitement, it's going to come back in the market. Thank you so much.